Hello and welcome to the stock specific class here for Thursday, July the 21st. As always, if you have any questions during the week or any that I don't get to in the live class here, make sure you send those to jerry@traderspro.com. Lots to talk about today. We're starting to see a possible shift. I talked about this early in the week, or last Tuesday, where I was talking about how, we could see, because the market was so negative, that we could see it rally for maybe an extended period of time. Now, we haven't seen any really strong rally or strong moves over the last 2 days. We saw a pretty good move with some pretty good breadth last Tuesday. Last couple of days, I'd kind of characterize a little bit of a pause. So we're still in an area where we could go reverse and go down. There is possibly that bearish ABC pattern that I had talked about for the last couple of weeks, possibly forming. But the thing that's starting to change my mind a little bit is there was a lot of participation, a lot of breadth that took place on Tuesday with that rally. We're seeing a lot of stocks that have been beaten up quite a bit during the decline that are starting to look like they're forming possibly bullish reversal patterns. And the reason why that's important is because I think I mentioned this earlier. I can't remember which class. I can never remember when I say what, but when the market bottoms, it doesn't mean that every stock bottoms at the same time. There are going to be stocks that will bottom before the market bottoms, and usually it's going to be some of these companies that have just gotten hammered, and so when you start to see them looking like they're turning around, then that could be kind of that early sign. Now, a bottoming process can be several months, so it's not like you're going to look at that and say, "Oh, we're done." I keep going back to the point that we haven't had that panic sell-off yet. I don't know if I talked about this on Tuesday or not, but I can show you kind of a theory of mine that might play out that could give us that. And still possibly not take us to new lows. We might have already bottomed as far as the price, but we might get that panic sell-off that fails to go to a lower low. That could be actually a very strong indication that things could be done if that were to take place. But I'll kind of play that out when we look at the chart here in just a second. Now, for the first time in a little while, we are going to pay a little bit of attention to the directional alerts. First of all, we're still in a bear market. Okay, so we're not going to assume that everything's just going to start going up. We are still considered in that downtrend, and so it doesn't mean that we have to stay out completely. We can add some positions, but we need to be aware of that. So particularly when it comes to your stops and things like that, and that'll be very important because I'm going to add a few things to the portfolio today. Knowing where you're probably wrong and knowing when your thesis is probably wrong is very important, and the discipline to follow through on that is very important. So I'm going to point out some key things that we'll be looking for, but it doesn't matter if I point them out if nobody follows them if they start to play out. You've got to, and it could mean that you're taking losses. Well, it should mean that you're taking losses if that happens to play out that way. And it's okay. I mean, you gotta get comfortable with taking losses if you're going to be in this business. If you're not, get out and do something else. Get out and do something that has a very low failure rate. I always use the baseball analogy. Baseball players, they just get used to failure. They learn to thrive. They learn to have confidence in failure. They're only getting a hit 3 times out of 10 if they're the best at what they do, and yet they're they can be some of the most confident people to be around. And you might say, well, how can you be that confident when you're failing 70% of the time? Well, because they know they're gonna fail 70% of the time, and that still makes them the best at what they do, and so they embrace it. Some people can't get used to that, and they go find another sport, and that's fine. In basketball, if you're a good shooter, a good free throw shooter, you're hitting 8 out of 10 free throws. Okay, so you're winning most of the time. So maybe that's more along the lines of the sport you want to play in that case. But that's okay. We want to recognize conditions. Now, I always talk about this too. That it's all about reward to risk. There is no perfect entry technique into a trade. You could get in early when you see a bullish candle. You could wait until you get a buy signal with the algorithm, the software. You could wait for a breakout. Maybe that's your thing that you like to look for. But with a lot of early signals, if you're going to just go off of a bullish candle and like a bullish ABC pattern and a bullish candle, something like this, you see a stock that's pulled back, but it has like a ABC pattern, it's probably going to have a sell signal as far as the signals are concerned. But you see that wave C looks about the same length as wave A right here, and then you get a nice big bullish reversal candle. Maybe that brings you to a hold signal, but you're still not at a buy signal. Okay, what would be the benefit of getting in early right there? Well, I know that I'm wrong right below here. Then we're not starting the next move up. It could keep my risk very small. Now what will happen a lot of times, and you've seen this happen. This has happened 2 or 3 times in the last few months where we've had a similar pattern like this. It looks like a bullish ABC pattern, looks like it's moving up, and it reversed right down, and I got stopped out. Your risk of getting stopped out is a little bit greater down here because there's less certainty that it's going to rally up from there. It's still in this kind of downward move as part of that correction. But if you're right, the potential reward is much greater if you're right. Okay. Now you might say, I don't like to get stopped out a lot, so I'd rather wait for a little bit more confirmation. Okay, well then wait for the buy signal. Buy signal might show up maybe halfway into the move right here. You've got a little bit more data there that it's coming off the lows, a little bit stronger. That might make it a higher probability that it can go up from there. But if you're, especially down here, still where you'd be wrong, you put your stop down there, and if you are wrong, your loss is going to be greater because of it. And so that's the trade-off. You get a little bit more confidence in your entry, but your risk is going to be a little bit greater, and your potential reward could be a little bit less. But you would have a higher probability at that point that you're moving up. Now you could wait for a breakout. That's going to come even later. Now breakouts are kind of nice because you can still keep the risk pretty small. Put your stop down a little bit below that area there in case it comes back and retests the breakout. But again, you could have missed part of that. You could have missed the profit move up to the breakout point in the process. So the point I'm trying to make is they're just decisions. There's not a right or wrong decision. What I'm talking about here, though, is we're in a bear market. We're in a decline, but it looks like we could be turning things around. We're in this area right here. So if I'm entering trades right now, I'm taking a little bit more risk in the entry, but I have the potential reward if I'm right. But it also means I could get stopped out a number of times, and that might happen in the portfolio. Now we're up 20%. So we could afford to be wrong a few times and not hurt us too bad. And if we're right, we can make a killing. So just keep that in mind when I go through. I'm starting the class this way because I just want you to understand, because the first question I'd start getting would be, well, Jerry, you don't have the buy signal yet, or we're not in a bull market yet. Why are we getting into trades? Or shouldn't we wait until we get into a bull market? Yes, you can. But what you're saying then is you want to wait till you're later into the cycle. The momentum is already up at that point. And as a pure trend trader, momentum trader, that's exactly what you're waiting for. But then what I would come back and say is, okay, then just skip the next few classes until you see a bull market show up there. You're going to be sitting on the sidelines until the bull market hits. Okay, so and that's fine. But so there, I have different types of traders in here, and so I'm going to address different types of styles and different techniques that you could use. Pointing out that there's no perfect technique. It's just a matter of you still have to manage it, and the management is the most important part of the process anyway. Okay, so anyway, so I just wanted to preface that. So if you're saying, well, Jerry, why are we recommending a bunch of trades today when we're in a bear market? That's the context. That's why we're taking a little bit of a chance here, but we're not going to take a ton of risk. All right. But what I said that we need to pay attention to now is that, remember, these are telling you we've been rallying now for a few days. So now these indicators start to become important to pay attention to. We were in the middle, so we're in kind of the no man's land in here. Now momentum is starting to move into the buy range. So what this is telling me is that the trend is moving upward now. We are starting to get these very early signals of trending upward. We're not in the extreme range. So if we are starting to rally right here, we have potential to rally significantly right here. And by significantly, I'm not saying for several months necessarily. I'll point out different areas on the chart that I think that we have to pay attention to when we get to that point. But this is saying that yes, we're starting to trend. We're out of the kind of the sideways range here. We're starting to trend, and that could have been the opposite. We had this rally. We could have rolled over and started to trend downward again, and that could still happen. We'll have to pay attention to that if it starts to happen. But now it's saying we're in the kind of the early stages of trending upward. We're in kind of this bullish trend right now, but we're not extreme, so it can run for a little while. Doesn't mean you won't have little pullbacks along the way. That's important to understand. You have these uptrends will stair step. You'll have an impulsive move up, corrective, impulsive, corrective. But we still have a little bit of room to run there. The breadth is starting to take off. Remember, breadth was really weak in the last update. We were down in here. Now it is still in the middle part right here, but again, seeing the market trend, that's something we want to pay attention to as well. I talked about on Tuesday, we saw a lot of participation in the rally. There was like 90% of the stocks were up on Tuesday. So it wasn't just, the FANG stocks or the Dow industrial stocks that were leading the rally and everything else was crap. Almost every stock was participating in that rally, and that's what you like to see in a healthy trend, is that there's a lot of participation. So we want to see this breadth indicator start moving into these areas here, but we are kind of in the middle on this one, but we have moved up from where we were, so we're kind of trending in the right direction, at least if you're bullish. And then sentiment has moved back into the complacency range, which you would expect it to. It's been in these two bars forever, but we're not at extreme. This would really have to get to the far right side for me to think there's extreme sentiment in the market, or extreme complacency in the market. So this is telling me that the rally could continue for a little while based on these indicators. You also go into your buy-sell ratios. We're seeing the buys outpace the sells, but that distance isn't too wide. Probably if it gets up about here, that would be considered overbought. We're not there yet, so this is indicating we could run a little bit. And then this sentiment indicator, again, we're trending up, but we're not at the overbought area yet either. So these are all signals that we're starting to see the market turn a little bit more bullish, but it's not extended yet. Yeah, I saw your comment there. You'll see that comment is actually the comment was that the SPY has actually got a buy signal now, and yes, I did notice that, and yes, we're going to do something about that. We're actually going to add the SPY to the portfolio, and I'll explain why when we get to that point of the class. But and why I think that's a great strategy to do this using those index ETFs. All right, so again, these steps are all important. I know we go through them in every class, and it seems pretty repetitive, but we're trying to gather information about the market. Is it overbought, oversold? Is it trending? What direction is it trending in? Where are the warning signs that it could be reversing trend? And all that kind of stuff. Another thing to point out here too, if you go into the index tab, you remember a couple weeks, maybe it's been a few weeks now, we were looking at this when the market was near the lows there, near those June lows. We were seeing extreme oversold signals on the ratios here. We were below 1 on the ratios here, meaning there were tons more sells than buys. And now we're starting to see positive numbers here. Take the Russell 3000 right here. There's now 7 buys for every 1 sell. You have 902 buys, only 129 sells. Now there's a lot in the middle, but that means a lot of these have shifted, because just a few weeks ago this number was like, it was the opposite. There was 7 times as many sells as there were buys. Now a lot of these have moved into the hold range, and now they're starting to move into the sell or into the buy range now. Now, what would it look like if these numbers are starting to get overbought, meaning too far too fast? Usually double digits is what you'd look for, although that's kind of a relative fact. We'd look at the other direction alerts as well. Are we getting into is the momentum in an extreme overbought, is breadth in extreme overbought, is sentiment in extreme overbought, and we're getting double digits on these ratios right here? That's when you have to think, oh man, we could be due for a pullback. We're overbought. We've gone a little bit too far too fast. Now, there are a few that are double digits, but Dow Transports, again, there's only a handful of stocks in here anyway, so it's easy. It's not too hard for those to get into double digits. I would say the Russell 3000 is the most. It's basically looking at as many companies, at least that are big enough that you'd even want to trade out there. If that started to get into the 11 or 12 to 1 range, that would be a little bit overbought. We want to pay attention to that, but we're not there yet. But this is a pretty healthy number here. This means that we're seeing stocks going to buys, and it's not overbought yet. So we got a sweet spot right here where I think we could take advantage of it. I'm not going to go all in the portfolio, but we're going to definitely add some positions today and get a little bit more money working in these conditions, because if it is going to go on a run right here, we can take advantage of it. All right, let's take a look at the charts. And, just the signals here. You can see what he's talking about here. We've gone from hold to buy. I'll talk about that here in a second. Now, for a long time here, I've been talking about, from back here, I thought this could be wave A, wave B, wave C, could bring us up around this $400 level. I talked about this gap, filling in that gap. Then when we kind of reverse right here, I said, well, it still could be a bearish ABC pattern. It could be that this is just wave A, this is wave B right here, and this is wave C, and then we could reverse. I still am looking at that $400 level and filling in that gap. So you might say, well, Jerry, why are you starting to turn more bullish? Do we need to be aware of a possible bearish reversal? Yes, we do. We still do. By the way, if you're waiting until everything's showing that the market's guaranteed to go up, you're in the wrong business. Go into something else. We just look at probabilities, and that's part of what I'm trying to teach you is you got to look at both sides. We got to try to look at everything and make a decision. The market is just not acting like it wants to go down right now, and it's rallying from a point where there was so much bearishness out there. Most of the people out there were bearish. It's hard for the market to drop in an extreme condition like that. Now, like I said, well, couldn't that mean that we're at a bottom? That is a bottoming signal, by the way, when people are overly bearish. But again, come back to this. We never had that really panic sell-off that is almost happened every time there's a major market bottom. And so I still think it's coming. I do need to pay attention right here, because what if we get a big bearish reversal candle? We gap up tomorrow. We then sell off and close lower than where we opened, but maybe still higher than today. So it would show that the market is up, but it'd show a very, very strong bearish reversal right at the spot I've been talking about. What would I do then? Well, I'd be concerned, definitely. You probably need a little bit of confirmation on that. But let's say it started to move down. I might be getting stopped out of these trades that I'm getting into and that I've been in for the last week. That's definitely a possibility. Okay. Now, I could, one of the things I would probably do is immediately jump into the SOXS and the SARK. Those are going to go up if the market goes down, so I can hedge myself immediately if I see that happening. So am I panicking right now that could happen? No, I've got a countermeasure. I've got a plan in case that happens. Remember, I used the football analogy. If I see that team lining up and that's a running formation, they're likely to run the ball. I'm ready for them to run the ball if they're going to do it. And so I'm prepared. What you don't want to do is not have a plan and then have this thing reverse and then, what do I do? Now you're just selling everything just to get out because you're panicking because you're losing money. And maybe that's just a one-day drop. We had a bearish reversal right here. I told you about this on Monday. I got sucked into that bearish reversal. I thought, we're going to go back down to these lows right here. And we didn't. We reversed it and broke out. But we do have to pay attention. This still could be a bearish ABC pattern. Now, one of the reasons why this is starting to become less probable is based on a retracement concept. If you've gone and seen the video on YouTube, go to Traders Pro, subscribe. It's free to subscribe, doesn't cost anything, and then look for the Fibonacci analysis class that I do. It talks about Fibonacci retracements. Stocks will tend to retrace about 50% of their moves. So you have this impulsive move up. When you get that ABC pattern back down, it'll usually retrace about half of that move up. So it'll usually come in about right here. And that's the concept of the retracement. Stocks will tend to retrace about 50% of their moves. Now, because we don't look for exactness in things, we look for more of an area or a zone. There's what we call the retracement zone, meaning that the minimum retracement we typically look at, and again, doesn't mean it couldn't be shallower than this, but typically the minimum retracement is 38.2%. Then you have the 50% retracement, which is the main concept. And you can have a little bit deeper retracement, which is the 61.8%. Now, these percentages are Fibonacci numbers. And if you want to ask me why we use them or why they work, they just do. It's the Fibonacci ratios. I talk about this in the recording, a little bit of the history of Fibonacci ratios. They show up all over in the universe, in nature, in the human body. There's Fibonacci relationships in the distance from your elbow to your fingertip on your arm. They're everywhere. And again, so if you're asking me the whys, I'm not smart enough to explain the whys. You're going to have to talk to some mathematician that can give you a lecture on the whys. I just know they work. and they're significant. They don't work all the time, and they're not exact, but there's something about these ratios that you have to pay. It's kind of just freaky. You have to pay attention to it because there's these relationships exist. So we have this zone right here. Now, the reason why this zone becomes important is because if you pull back less than the 38.2%, then you always worry that it hasn't pulled back enough. So you have this little pullback right here. You're not even a third of the way into the retracement. So the reason why I worry about that, thinking that that's the pullback, is that might just be wave A, and then you buy in on the suckers rally in wave B, and then it rolls over and comes down in this area here, and you're like, oh, it did end up getting into that area. Now, there are a few of these shallow retracements, and that's what keeps us on our toes. Is that it just because we get a shallow retracement, we don't know if that's it. And that's part of what can suck people into that wave B. Is you could point to a few times where it made a real shallow retracement and took off, and that could be your justification of not wanting to miss the next move. But the majority of the time, you're going to get into this zone. Now, the bottom part of that zone becomes important because that's when you start to get past the 618 retracement level. Could it still rebound and go up? Could it still rally and go up? Yeah, but the probability of it rallying and going up at that point is less. It starts to diminish dramatically. So again, there are possible moves and probable moves, and that's always going to be the case. Is it possible it could still go up? Yes. Is it probable? Probably not. So, if anything, that your perception needs to start to shift at that point. If it moves past that 618 retracement, I've got to start to shift it more towards another direction. Not all the way yet, but I've got that becomes a key level there, because I recognize that now you're moving outside that zone. We could be in a downtrend. Maybe this isn't a pullback within the downtrend. So in other words, here you have your uptrend. You start to retrace. Okay, that's not deep enough. You're at the 50% retracement. Okay, we could still be in this uptrend. We could still go up. You start to get beyond that 618 retracement level, and you have to start to say, well, maybe we're in a trend reversal now. Maybe we're not in a pullback within an uptrend. I've got to start to look at the fact that maybe we're going to start stair-stepping down now. Okay. Hopefully this is making sense, and I know we want exactness. You want me to give you a formula that says if it does this, it's always going to move up, and we're never going to lose money, and that's what we're looking for. And no, it's a grind. It's all these little clues and little things that you're analyzing, and then you still, on top of that, we're not even addressing yet the trade management part, where we got an allocation, which are so critically important as well. It's a process, though. So let's take a look at where we're at on this retracement. We do have, so far we have potentially that could be wave A, wave B, wave C. Wave C looks about the same length as wave A, maybe a little bit shorter, but about. So that could fit that criteria of it rolling over and going down. We're just getting very close to filling that gap. Let's look at our retracements. Now, we use the retracement tool, and there's, again, the video on Fibonacci retracements goes over all this, but here's the Fibonacci tool. You put it on the screen, and then you have to highlight the area that you want to measure. And what we're going to be measuring here is you want to look at the last impulsive move that you think, you want to look at the impulsive move that you think this is correcting. What is this correcting? Well, it's correcting this impulsive move down right here. This is the last step. Here's a trend down, here's a step, here's a trend down. I want to go from where that last move dropped, and we're retracing that move down right there. So I'm going to highlight from the top of this move down to the bottom of this move. So I want to highlight this area right here. And what you're going to do is you're going to click the selection tool, which is this little arrow right here. It says it's selection tool. You're going to left click and hold it. It's just like you copy and paste. You're going to left click and kind of, you'll see me highlight the area there, but it's kind of like a copy and paste on the computer. So let's put the Fibonacci tool in there. Now it looks like it's automatically measuring it, but all it's doing is grabbing what it sees as the high and the low that it can see. We want to focus it on this area right here, so it'll grab this high and this low, and it'll measure the retracement levels there. So we're going to use the selection tool, and I'm going to highlight this area right here, and it's going to zoom right into it. So right back here, it's just, there's that drop. Now look where we're at right now. We are exactly at the 618 retracement level. Okay, but this is not looking like a bearish reversal candle, and we still need to go a little bit further to that 400 level to fill in that gap. So we're about $4 off of that. Now, like I said, if we were to gap up to 400 tomorrow and give this a bearish reversal candle, I would start to have to seriously consider that we have another move down, and you could wait for this, okay? You could wait for that to play out. Now, I'm going to give you reasons why I'm not going to wait for it today, part of which is that I'm trying to do all this in live class, and if I wait till tomorrow and we get all this, we get confirmation to get in tomorrow, and I've got, I'm getting into trades and nobody's able to see me get into trades, so I am going to jump the gun a little bit on these. But there's a reason why I'm okay with jumping the gun. First of all, again, we're rallying into that 618, but we're not looking weak. Maybe you could say we're off the highs a little bit of the day. We opened a little bit lower today. Maybe you could call this, and if we fade a little bit in the close, it could be a little bit of an indecision candle. But here's where I'm going to look at as well. To bring it back, to reset, you just hit this little back arrow right here to reset it, the zone. It'll snap the chart back, and then you can take the lines off by clicking the Fibonacci box right there. Let's take a look at, and by the way, why am I looking at this as potentially bullish? Well, there's a possibility. Remember, when you're in a downtrend, you're alternating between impulsive, corrective, impulsive, corrective. Typically, when you reverse trend, you're going to get back-to-back impulsive moves in the opposite direction. So you look for impulsive down, impulsive up, and then you tend to get corrective, impulsive up, corrective, impulsive up, correct. We have impulsive down right here. We have impulsive up right here, and then we got corrective. Now this is looking more impulsive. Now in the early stages, it could look like it still could be a bearish ABC pattern, and we could reverse. But it could also be the start of a new uptrend. And if we get above this level right here, we keep going higher, it's going to look more like a trend reversal. If we break above here, I've told you this is significant because now you've gone to a higher high. You're in a trend reversal. And again, I'm looking at this as maybe just a bullish run that I think could happen for a few weeks. Okay, I'm not saying that we're done, we're bottomed out, we're starting a new bull market. Okay, a lot of it is again because the market was overly bearish. It needs to turn more bullish before you can have a panic sell-off. And so I think it's going to start looking more bullish. It's going to suck some people in, including us, but we're getting sucked in because we know we're getting sucked in. We want to take advantage of it. We say, okay, we know we probably have another panic sell-off coming, but hey, if we could rally for 3 or 4 weeks until then, let's make some money while we're waiting for that. And be aware that we could start to see bearish reversal candles, and we'll take a look at the chart. The chart should give us a warning when we might need to get out. What could that warning be? Well, we could rally for a few weeks right here, and then suddenly what happens is we get into this extreme, we get into the extreme reversal risk on the far right side of the extreme reversal risk. We get the direction alerts flashing overbought extremes over here. We get buy-sell ratios that are getting into the double digits here on the indexes. So we're going to get some warnings when this rally is getting overextended, when it's sucked enough people in where it could rip them apart, and we'll tighten up stops, or we'll take profits, or we don't even have to. We don't know for sure if we're ever going to get a panic sell-off. We could just, if we get a bearish reversal candle, buy some SOXS and SARK, and if the market drops suddenly, those will go up, even though our stocks will go down, and we'll offset that risk a little bit. Okay. So that's the context here of what, oops, yeah, let me go back to this SPY chart right here. And you can see this is a critical area right here. Now you say, well, Jerry, why not wait until we actually break above some of these levels here? Well, here's why I think we're okay getting in now. We haven't been looking at these other indexes. Let's look at the Nasdaq 100. Possible bearish ABC pattern right here. Let's measure the retracement. Here's the last move down. How far has it retraced that move down? Oops. There's the 618 retracement. We're now again, maybe this fades into the close, and if it did, that'd be a reason why it would freak me out and make me turn bearish again, because now that'd be back below. It'd be back below that 618 retracement level, and I think closing prices are important. So if it closed back below that 618 retracement level in the next hour and a half, then that would be bad. But it's looking like a clear breakout above there. Now, how do we tend to look at the tech stocks? The tech Qs are considered the tech sector. Do we tend to look at tech as a leadership group, as a group that leads the way? Yeah. Now, there's other leadership groups, so let's take a look at a couple other leadership groups. Russell 2000. Now, by the way, if you wonder why I don't use Fibonacci lines a lot of times in class or on the charts, for one, it takes a little bit of time to put them on there. But after a while, when you do this for a long time, you know where those levels are. Not necessarily to the dollar or anything like that perfectly, but I know where this zone is. You know, it's like again, I use the baseball analogy. When I was playing baseball, I knew where that strike zone was. I knew if that was a ball or a strike, and that's a lot of times when you get the batters arguing with the umpire, because it's like, hey, I've been doing this a long time. I've looked at a lot of these pitches, and I know where that strike zone is. Maybe not perfectly. I could be wrong on the fringes, and that happens. Professional hitters a lot of times are wrong when it's barely out of the zone or in the zone, but they know where that zone is without having to have it drawn out. So I know, just eyeballing this, that we're right, very similar to the SPY. We're bumping up against that 618 retracement. Let's see here. Why does it not let me? There we go. See? So we're a little bit above it, but again, not as much as the Qs. Now I'm skipping ahead a little bit here, but what's another leadership group I always talk about within the Nasdaq? Chip stocks, SMH. Here's that last move down. They've gone to a higher high. Now, even if you were to say, well, maybe you're going to look at this move down, how far does it retrace that move down? Okay, let's do that. Let's just throw that one in, just in case this was just a little bump right here and it wasn't really significant. I think it's fine, but let's just assume that. Let's measure from this previous high right here. I don't know why it's being grumpy with me today, the selection tool, but there we go. Look at that. Even if we'd said, okay, we're going to ignore this move, we're going to take this whole move down, we're above the 618 retracement level. Clearly today. Now, again, going back to what I said, you can move above the 618 retracement level and still go down. You can have deep retracements, but like I said, I think it's interesting that you have this higher high, you have this higher low. It's acting like a trend reversal. You can even throw in inverse head and shoulders pattern right here. This clearly looks impulsive. If you're saying, well, this is wave A, wave B, wave C, well, look how long wave C is. Wave C is supposed to be about the same length as wave A. It could be a little bit longer, a little bit shorter, but that's twice the length of wave A. That's not a correction. This is not acting like a correction. That's turning me more bullish. Okay, so that's kind of setting up from the chart, the chart perspective of why we can maybe start to jump into some things. Let's take a look at the other indicators here. Bonds could be in a trend reversal. Now, on Tuesday, I talked about we got to focus on this high right here and this low right here. We've been moving sideways, but I also said this is where you have to look to be more bullish, because that was the previous lower high after or before you hit the lower low. You hit the lower low right there. That was the previous lower high. You got to get above that to get a higher high. We've just been moving sideways. So even if we do break above here, it doesn't necessarily mean that we're in a trend reversal. But the reason why I'm thinking that we're acting like a trend reversal is the fact that we're moving way sideways right here. And this is looking like an inverse head and shoulders pattern right here. And that is going to make this high right here very important, because if we break above that, I really think we're in a trend reversal on bonds. Not there yet, though, but we'll keep an eye on that and see how that plays out over the next little bit. Gold, we were in a downward move. We were moving a little bit sideways right here. Dropped down, moved up. This is all kind of still sideways right here. I'd still say we're acting like a downtrend. Now, if this starts a 3 or 4 day move where it really jumps up in an impulsive type move, maybe there's a little bit of a trend reversal in gold, but I'd still consider it's in a downtrend. Oil, we talked about this possibly being a bullish ABC pattern right here. Now, this is what I was talking about earlier. Remember, earlier I thought this could be the bullish ABC pattern. Now, I didn't take a trade right here, but look what happened. It moved up. I could have gotten in and then put a stop right below here, knowing that maybe that isn't the low and I could get stopped out. But if I'm right, I make a ton as it works its way back up. That would have been the risk of an early entry. Now, I didn't like the market conditions at the time. They were still looking more bearish, okay? So I didn't want to jump into that. This is why we're analyzing everything. We're not just looking at one thing. And it was a good thing at that time. It went lower. I would have been stopped out. But now we're getting more bullish conditions, and we're getting a rally right here in oil. And so I decided to take another trade there, put my stop down below here. We're down a little bit today, but that can happen. That was a pretty sharp move off the lows right there. So you're due to have a little bit of a pullback. Let's see. It's still an aggressive entry, though. It's a better entry just because the conditions are more bullish. But I could still get stopped out, and I'm okay. I was willing to risk that entire amount right there, and there's still that chance I could make twice that if we get back up to the previous highs. But oil, so oil I'm still bullish on. We'll see if, now again, here's a move off the lows right here. Here's about a 50% retracement. Here's about a 618 retracement. If we start getting below that 618 retracement level, I'm thinking more and more like I'm going to get stopped out. By the way, could you put stops below a 618 retracement level? Yeah, but they're, right at the 618 retracement level, it can be, again, it's not exact. It doesn't always just stop there and reverse, and you can dip a little bit below it and still go right back up again. So you might find that you're getting stopped out a little bit more often. But if you're looking for a tighter stop that you could be consistent with, you can try it. But if you're finding you're getting stopped out too much, you might want to give it a little bit more room, a little bit more wiggle room there. But that's a valid technique to use. And sometimes, again, there's no perfect technique. Sometimes I'll use different stop loss techniques for different trades. Maybe I'll look at something like this and say, maybe I don't want to take that full risk down here. How can I lessen the risk even more and still know that, I still have something I could, a reason that I can know I'm probably wrong. And you can say, okay, well, let's put that stop at the 618, below the 618 retracement level. Well, it's probably down here a little bit further down. Probably right in here. If I get below that, okay, now I'm risking a little bit less. I'm probably wrong. It's probably heading lower at that point. And if not, I can always get back in. If it snaps back again, I can always get back in. But that could keep your risk a little bit tighter. But again, as with all stops, people talk about tight stops. I don't want to lose very much. If I can have the potential to make a lot of money and lose very little, usually it comes with getting stopped out a lot when you have those tight stops. But that's okay as long as you can handle the increased losses. And usually you can handle it if you know, hey, I can always jump back in again too. It's not like that trade's dead forever. Then usually a tighter technique like that does work out. But you might get stopped out 4 times before you get the big move where it trends for several months and you make a killing on it. Like that batting average, you got to be okay with the getting more losses than wins, but the wins are producing more return because of the reward to risk that you're looking at on your trades, and so it's worth it to you. You're making more money than you're losing. That's all we're trying to do with any of these techniques. Dollar. What did I say to look for? We have impulsive up. I said this is impulsive down. What did I say to look for to indicate that maybe we're in a little bit of either a trend reversal or a little bit of a correction in the dollar? Look for the next correction. Look at where it starts to move sideways. This is looking more sideways. Now, it's only a 3-day move, but it could be that this is wave A and this is forming right here. Maybe it has another rally day or two, and that forms wave B, and then you get wave C, and then it takes off again. I don't think the dollar is done going up necessarily, but we saw up here, what did we see up here? We saw impulsive up, and we saw extreme reversal risk. And so we said, hey, this is an area where you'd start to see a correction. So it shouldn't have been a shock then that you get this impulsive down. It alleviated that. Now the way it's behaving, you're saying, okay, if it would have pulled back in kind of this real choppy kind of move like this, and we said, okay, maybe there's a correction right there, and it's going to take right off. It's just a smaller correction, kind of like right back here or right here. But I had a sharper impulsive move down. So now you're saying, okay, do we think the dollar is going to reverse back into a downtrend? Maybe. It'll start acting like a downtrend, but this could be wave B, and then this could be wave C. It could just be a larger correction. it gets down to this area right here where you have support, resistance, or mostly resistance right here. Wave C could look like the same length as wave A, and maybe that's where it starts to rally off of. But breaks through that, and this really looks impulsive, and then it's acting like a downtrend, and we'll call that a trend reversal in the dollar. But right now, we're just thinking we're in a correction, a larger correction in the dollar, possibly. The VIX. I think I told you this on Tuesday that I wanted to look. If we broke below this, that would be more bullish for us, and we're clearly below that today. The next support area is down here, so this is telling me that possibly we could rally for a few more days. Now, when it's gotten down here, we've seen some of these spikes off of these levels, so maybe we get just a 2-week run, or maybe even just a 1-week run where we rally up a little bit and get down these levels. Maybe have to worry about a potential trend reversal there. But the VIX is saying it's indicating no concern for a pullback here. So I'm looking at that potential of a bearish ABC pattern. We're still thinking that could be a bearish ABC pattern, but we're not seeing any indication of fear that we could drop. There's nobody buying protected puts thinking that maybe we're going to drop. Just the opposite. It's moving lower there. So that's a little bit more bullish. Okay. We talked about the SMH. We talked about our transports here. Again, they're looking kind of the same thing. Could this still be a bearish ABC pattern? Correcting that move down. Yeah, they're still kind of in that critical area. You could also look at this as kind of a double bottom right here, and we've gone to a higher high right here. We had lower highs, lower lows. Could it be a real subtle trend reversal? Yeah, it's still a little early to tell still, and it's down a little bit today. Transports are down a little bit today, so that's something to keep an eye on. Why are they showing a little bit of weakness? By the way, if we look at all these clues, don't expect all the clues to tell you the same thing or to line up. We're just gathering information. We're trying to see out of all these clues, is there real subtle signals of a slightly more bullish outlook, bearish outlook? We are in earnings season. There's a lot of wild cards out there, the headlines that could throw the market in another direction. That's okay. We know how to deal with it if it does, right? We can use hedges. We've got things to hedge our portfolio if it does. We can jump right in and start using them. Bitcoin really had a big run up here. Now, remember what I said, though, and keep an eye on Bitcoin here. I said out of these sideways ranges, I used the bullish example. I said sometimes we get these real flat sideways ranges. You'll get a dip below that will, because nothing's really playing out here. The buyers still aren't buying, the sellers aren't selling, and it's stuck in this range. Previous trend is up, so you would expect it to break to the upside. But the buyers just aren't. It's not low enough in the zone yet for them to get excited to buy. So sometimes it will dip below that zone. The buyers will suddenly get excited and push it out. The opposite can sometimes happen within a downtrend. The buyers and sellers can't really decide what to do. It finally breaks out right here, and maybe the short sellers say, okay, this is a better place to short right here, and maybe that's what they're doing. Who knows? Maybe this could lead to that drop. We also, though, this could just be a rounding bottom right here. What if we just pull back a day or so and then break out again? Okay, now we're acting like an uptrend, higher low, higher high. We already got a possible higher high right there. So either of these could play out in the next few days. It could make it more likely that Bitcoin rallies a bit more, or maybe it's that what I just showed you there, that it broke out of that sideways. The previous move was down. It broke out a little bit for the short sellers to get excited. This is where they want to short. They didn't want to short so much right here, and then they drive it down. We'll see if it plays out that way. All right, that was a long class for this, but hopefully you see there's a lot of the stuff that I wanted to point out to kind of set up for potentially the trades. So again, my conclusion is I'm leaning a little bit more to the bullish side, but I am going to watch this area pretty closely here on the S&P in case it gives me a bearish reversal signal, and we can hedge if it does. But this brings up a point then. If the market is looking like it could rally, you should have a market ETF in your portfolio then. Why? Now, it's important to point out that these market ETFs are not going to perform as well as individual stocks, meaning you typically don't get as big a percentage move when they're trending up as you would with an individual stock. But one of the frustrating things in trading is that you have I find this all the time and every day. I'll get a list of 10 stocks that I think are going up. I'm not going to be able to trade all of them, so I pick 2 of them, and the 2 I pick stagnate or even go the opposite direction in the next few days, and the 8 that I didn't pick explode, right? How many of you had that happen to you? Well, get used to it. It's going to keep happening to you. It's part of trading, okay? But it's also part of why we try to diversify a little bit, because we don't know which ones are going to take off. They all look bullish. We don't know which ones are. But we want to capture at least one of them if they do. So we spread things out a little bit. But another strategy is it's like, okay, if the market looks like it could go up, I've got 10 stocks that look like they could go up. I'm afraid of picking the 2 that aren't going to go up and have everything else go up, the market and all those 8 other stocks. Well, why not at least have one trade where you're trading the index? If the index looks like it could go up, and if it goes up, a lot of other stocks are going to go up. Well, at least have one trade on the index where you're participating, even if the return isn't as great. Okay. Now, I got a question here. Well, the SPY only has a 72 strength rank. The strength rank in this context is not going to be that important to us. It will be for individual stocks, because if the market is trending up, we'd like to try to find the stocks that have the higher strength rank in the sectors that are performing well, and the stocks within those sectors that are outperforming. But I'm telling you right now, if you're going to try to get in this early stage, this goes back to what I talked about at the beginning of class. You could wait until we move towards a bull market. You could wait until you're in a bull market, the bullish trend, and a 90 strength rank or above, 98 strength rank stock. And yes, we will run that system when we're in that condition, and it'll be robotic. We're in a bull market, we're in a bullish trend. We look for stocks with the 98 strength rank that are going from hold to buy. Just go back if you can. I don't know how many years you go back. Go back a couple of years when we were in an uptrend and review one of the recordings. That's exactly what we were doing. We're in a bull market, bullish trend, looking at 98 strength range stocks going from hold to buy, and it was like clockwork. You just keep plugging them in, and they're likely to keep. Not all of them worked, but they're likely to keep working because the momentum's there. That's the ideal trend trading process. But like I mentioned at the beginning of class, this is a technique where you can say, okay, there are things we can do early in the trend if we're willing to take that a little bit additional risk. And that's what I'm doing here. Okay. Now, the cool thing is I can keep my risk really small here on the SPY. My stop's going to go right below here. Because if this is wave A, wave B, wave C, and we reverse back down, that is going to be where I know for sure I'm wrong, and we're in another downward move, and we're not going higher. You say, well, what would this even be better? Well, if we break below here, we're going to break below here. Most likely. I mean, there's always the outside possibility you might not, but if that is a bearish ABC pattern, we get below here, we're heading lower, most likely. And if for some reason we do come back up to these highs right here, there's that potential for a big reward. I don't know that we're going to get all the way back up into there, but even if we just rally back up into here, I want to see if I can make some money on a move up. All right, so my stop is going to be at below this low right here. Was it 371.04? I'm going to just say 371. What would 100 shares be? That's too much, so we have to go less than that, so a lot less than that. Let's try 20. Squeeze 25 in. Okay, 25 shares would be right at, I'm trying to keep this between 7 to 10,000, and I want the portfolio at risk to be less than 1.5%. That's only 0.5%, so I'm only going to lose $650 if I'm wrong. That obviously it could be a little bit more than that if it had a big gap down or something, but that's fine. So let's go ahead and purchase this. Now, I know I'm running over time, but I still have a lot of stocks I want to go through, so hopefully that's okay. You have to go, just, and you can review the recording later. Just go to the YouTube channel when it's posted, and then look at, start it at the top of the hour. After an hour is when I start to get to the individual stocks, and then you can get the list that I'm going to go over here in just a second. But I want to zoom out a little bit because I want to quickly explain that what I think could happen. I talked about waiting for this panic sell-off to be a kind of that final indication of a bottom. That I want to see the VIX spike above 40 in that case. That would tell me it's a panic sell-off. What I think could happen here is we could rally up, break above here, looking like we're in an uptrend now. Everyone's going to think that's the bottom, and it could still be. That could still be the bottom, right? But then what could happen is we could get from right up in these levels right here, we could get a big sell-off right back down within a couple days to these levels. And that could spike that VIX up. And everyone's freaking out because they thought, oh, this is over. I thought we were done. And now how much further is this thing going to drop? I can't figure this out, right? And then it could bottom right here. Actually, this could be the bottom, but this could end up putting in a higher low right there. And then we could start rallying back up. So I'm not looking, this could be the exact bottom. I'm not looking for the exact bottom. I'm looking for the conditions of a bottom to make me comfortable that where a bottom is in. This would still flush out all the uncommitted buyers and really panic the market. And it would, if it gave me a higher low, that also would tell me that'd be very bullish because that panic did not lead to a new low. This is where we could start to get really aggressive. And it'd be great too, because you could use this as a stop to get very aggressive if it does drop back below there. And it could still do that, by the way. Sometimes you'll get a panic sell-off. It'll drift a little bit lower, but, you know, we could just be right back to that mood where everyone's bearish again, and we could move sideways for a little while. And then bottoms can sometimes take a little bit of time to establish. But if I got that panic sell-off, then I could look at and say, okay, now we got it. We got to be very close to it. Let's now start getting into trades that we're planning on being in for several months, even a few years, and just now it's just a matter of waiting for things to really get going again. And we'll make a killing. We've got all the capital to make the killing because we didn't lose all our money on the way down. And so that's what I think is possible to play out. But in the near term, why not make some money on this? If we get a signal that, and we should, that things are overbought and could reverse, get out or get hedged, get a drop, maybe even make money on the drop if our hedges are really exploding. Get the bottoming signal, really go in with trades, high strength rank companies and strong trending companies and strong trending sectors, and ride that move up. So that's kind of a big picture of what I think could possibly take place here. Now, again, it could all be blown to bits. Tomorrow we get a big bearish reversal candle. We're dropping lower again. There's your lower high. Go to a lower low. And okay, I'll flip-flop. I will be the first one to flip-flop because I don't care about being Nostradamus here. I'm not trying to make a prediction. So you should have listened to me. I just want to get the trend direction right. But I'm also prepared if that happens, right? We got our ETFs that we can use, our inverse ETFs that we can use to hedge. All right, sectors. I'm gonna go take a little bit more risk here, and we're gonna go down to business services and computer and technology. Some of these that we've been kind of holding off on, because I do think computer and technology, I think the Qs are going to lead the way if we rally up. So let's look at a few of those that we could consider. Let's start with business services here. I liked this SPSC right here, 92 strength rank. Some of these are going to have a little bit lower strength ranks because we're in a bear market. So we're going to have to maybe lower that just a little bit. And I didn't like some of these higher strength rank charts very much. So let's turn the signals on here. And so what I'm looking at here is, you say, well, this looks corrective, and it could be. It could just be a correction for another move down. But I'm also, because I'm, again, more bullish on the market right now, I'm looking at maybe this is just a real subtle higher high, higher low. It might be kind of forming that bowl-shaped move where it starts working its way up the right side of the bowl, which is one pattern I'd love to trade. Looks like it's breaking out to a slightly higher high today, buy signal today. I'd have to put your stop probably down here, which is a pretty wide stop, and the reward to risk wouldn't look great just kind of getting back up to the highs right here. But that's a bullish looking pattern. You could wait for it to pull back again, and then maybe that gives you a better spot for a stop. Question: are we not trading the Qs because it's taken off? You could trade the Qs. You could add the Qs and the SPYs if you want to. The S&P 500 is more the broad. It's incorporating everything. So usually if I'm going to put that in the portfolio, what happens if tech stalls and biotech starts taking off, or financials start taking off? Then it's just a little bit more of a broad. You're going to have a little bit more broad representation of the market, but you can do both. If you think that the Qs are going to outperform in the near term, and you want the broad protection, broad rally potential of the S&P. All right, so that's one. Let's take a look at another one here in business services. This XL, where is it at? EXLS, 91 strength rank. Again, you've got a little bit of resistance right here, but you're getting these higher lows. And you had a nice little bullish move up today off of this low right here. So now this is one that you could just put in the watch list and buy the breakout. Or if you think it's going to go break out, it's already tested that area a few times. At some point, it's probably going to break out of that. Maybe you think that pressure is building. You got a triangle formation here. It's starting to get pushed in the corner. You could put a real tight stop below yesterday's low, or one below this low, and so your reward to risk here would be very much And then if it did break out, it'd be a really good entry. There's an ascending triangle pattern right here. You can see a little bit better on the monthly chart or on the 1-year chart. It's just kind of all that pressure is building right into here. A lot of times it explodes out of that. And when it does break out, you can take the distance of the base of the triangle. That'd be the base of the triangle. Project that upward. That gives you kind of a minimum target area. All right, so another one. Now let's go into computer and technology. I like the CLS right here, 94 strength rank. And again, what I liked about this one is that it went to a buy signal today, but it has this real subtle possible inverse head and shoulders pattern right there. So you have lower, lower high right here, lower low, then a higher low, and with this move today, it broke. See, here was the lower low right here. What was the lower high before that lower low? Right here, and we're breaking above it today with a buy signal. Again, you could put your stop down below here, and here'd be the target, a minimum target that could work its way back up to, that you would expect it to work its way back up to. Maybe it doesn't get there, but that's a nice little pattern with the possible early reversal formation there. We've had this in the watch list for a while, but this GOGO, GOGO, 94 strength rank. You know, it's possible this is a larger bullish ABC pattern right here. Again, it's not really taken off yet. I'd want it to start looking more impulsive, maybe go back to a buy signal. You could whatever confirmation you want to look for there, but if you look at the longer term chart, you can see the pattern. Here's the impulsive move. Now this is maybe a deeper pullback. It looks like it could even be a little bit below that 618 retracement level, but that's why we'd probably want to see a little bit more confirmation. But that's one that could be potentially a good chart there with a little bit more confirmation. Put it in the watch list. Other computer and technology. This I think we have this one in the watch list as well. I don't know if we have GOGO. Maybe I know we have SIMO, CMO. Kind of the same thing, same kind of chart here. This was looking like an ABC pattern off of this move up. It has moved up a little bit here. Maybe you could wait for that to go to a buy signal, or however you want to manage it. There's lots of different ways you can manage it. Here's QLYS, 91 strength rank. And again, this was just based off of, again, kind of another possible triangle formation. It's putting in higher lows. There's a little bit of resistance right here. But if you feel like the market is going to push things higher for a little while, you would expect that it's going to finally break out of that. And I mean, this is an okay pattern right here. Like I said, I'm just giving you some ideas of some chart patterns I like. You don't have to. You're definitely not telling you to trade every single one of these, but sometimes what happens is that people maybe they like the sector, they like the company, and then I like a particular chart, or they like that chart, and that's what they want to go ahead and trade, or they know a lot about that sector or that business, and this is a chart that looks like it could go up, and so they trade that one. That's kind of the purpose of the class, is give you some ideas. One area that I think you could start to look into, well, before we get to that one, there's one I like here in the auto, tires, and trucks. We haven't been in that sector for a little while. But this Li Auto, LI is a ticker symbol. It's an 83 strength rank, but I just like that's definitely a corrective pattern, had a nice impulsive move. A little bit of a bullish reversal candle today. And this is close enough where you could wait for it to go back to a buy signal as additional confirmation, or wait for it to break out or something if you wanted to. But I thought I'd throw that one in there. One sector I want to throw in is the medical sector. This area in the chart, in the market cycle, is when you start to see biotech and medical stocks really take off. If you'll notice in the Dow, the strongest stock in the Dow over the last couple months has been United Healthcare. It's not unusual for that to happen in this type of condition. Very, very often when you get to the later stages of a bear market, you start seeing medical stocks, biotech stocks, healthcare stocks outperform a little bit. Okay. And so you can start to look, there's a lot of these too, and a lot of them have pretty high strength ranks. Now, some of them are going to be, they're stocks that are buyouts, or they're too small. There's a lot of really small biotech companies out there, and they could be very volatile. They could be all based on their drug getting approved by the FDA, and then it doesn't get approved and they drop 50% the next day. Or they explode 200% the next day or something. It can be a roller coaster ride. So don't be all in on medical stocks is what I'm trying to say, because or focus on ones that are maybe already a little bit more established, where they've got several drugs, and that it doesn't matter if one doesn't get approved by the FDA, they're not going to collapse. So you just have to be a little bit careful. Like you can lose a lot of money and just blow your account apart if you're focusing on too many risky small biotech stocks. Now, some of these too, the chart patterns aren't great. I'll see if I can find an example. There's some of these that were like, I wish I should have jotted them down, but they were like barely moving, and suddenly they gapped way up. Here's one example. So here's what it was doing for months and months and months and months. So something happened. They probably have some drug or something, and it just exploded, and it's pulled back. I usually avoid these because sometimes they can be based on a rumor or something, and they come right back down again. I guess if you want to speculate and do some research on some of these, you could do that. But I usually tend to avoid some of those. I like a more established chart where it doesn't feel like I'm going to get lucky on a move. I'd like to just see it actually trending up, where I feel like there's momentum there and not just pure luck if I'm going to make money on it. So anyway, a couple of these. I'm going to do just a couple because I'm running out of time. This AMPH right here, Amstar Pharmaceutical. I'm not going to try to read some of these names. 97 strength rank. Again, it had a big uptrend through here, and then this is maybe an ABC correction right here. Let's see if I can find a better pattern out there. There's this Vivo VIVO, Meridian Bioscience, 97 strength rank. Again, nice uptrend. Pull back a little bit right here. Kind of gone to a hold signal. You wait for it to go back to a buy signal. It's been trending up pretty nicely for the last few weeks. This MCK. This is, I mean, you could wait for the breakout here, but boy, this is basing right here. Big run up. You know, maybe a little bit of an inverse head and shoulders pattern. If it breaks out, this thing could take off. I got to skip down the list because I'm going to get into one of these in the portfolio, but I wanted, it's a little bit lower strength rank. Well, no, it's fine. It's 93 strength rank, but it's a more established company. Eli Lilly, LLY is a ticker symbol. Now, again, it's another one I could wait for the breakout. I don't know when that'll be, and it could be when we're not in class. I'm going to go ahead and get in here because I'm going to put my stop down below this breakout area right here. So about 310. And then if the market is going to go higher here, I think this is going to end up breaking out of the sideways range. So I'm kind of anticipating it'll break out. Now, again, it is a little bit riskier to do that, and it could still dip down and stop me out. It could still dip down, stop me out, and move higher, but I could always get back in. But I want to have some exposure to biomedical healthcare without getting into one that's really risky. So let's go ahead and do that. Let's add this one in. Stop price at 310. How much is 100? Oh, that's way too high. It's going to be another one of those where we're doing like 25. Let's do 25 shares. That'll be about 8,000 in the trade. Very little portfolio at risk. Again, not only like a $400 loss if I'm wrong. And let's go ahead and purchase that. And real quickly, I forgot to go. I wanted to add this one. It was under computer and technology. This will be the last one I'll add, and then we'll wrap things up. It's a little bit further down the list, but AMD, 87 strength rank, so it's a little bit lower strength rank. It's going to a buy signal today. It's breaking out to a higher high right here. And I know that if we do rally, chip stocks are going to lead the rally, right? They're going to be out front. If chip stocks aren't participating in the rally, that'll be a big warning sign that it could be done and could roll over. So I'm going to add this now. I'm going to have a little bit wide, kind of a wide stop right here because I do want to put my stop down. Oh, we could actually put our stop right here actually, because if it goes below here, we're wrong. We definitely know we're wrong if it goes below there. What would that be? What is that low right here? 74.43. So we'll say 74. We'll put a stop in at 74. $100 shares would be right at 99,000. Now, portfolio at risk, we're a little bit closer to that 1.5%. We're still below it. So I'm going to go ahead and do it. Although if we're wrong on this one, we're going to lose 1,700. Now you better be okay with that. If you're not, you need to buy half the shares or something. If you say, well, I could handle $700, $800, but not $1,700, okay, then reduce the shares then. But I'm okay with this, so I'm going to go ahead and purchase. Let's look at our portfolio here. We're not even 50% in, but we've added, and we may continue to add if we're getting stronger signs that we're rallying here. Now we're not hedged, so if we get a sharp reversal, I'll probably jump. First thing I might do is just, because we may not be at stops yet, but I may just run in and buy the SARK or the SOXS so that we're hedged a little bit if it drops. But so that's the plan. All right, I got to wrap things up. Thanks, everyone. Hopefully that was helpful today. I don't like to go this long, but I will if there's things to talk about. Have a great week. We'll see you on Tuesday for the next market update. Bye now.